Welcome to the Commercial Real Estate Deal Room. In today's Deal Deep Dive, we're analyzing Chick-Fil-A in El Monte, California, right in the heart of the San Gabriel Valley, about 12 miles east of downtown Los Angeles. And if you've ever wanted to invest in real estate to build wealth, passive income, and financial independence, but weren't sure where to start or how to actually analyze a deal, this channel is for you. Every week, I take a deep dive into an investment property and walk you through how I evaluate it, going well beyond the headlines and the glossy brochure, so you understand the real risks, not just the upside. And this is where my background becomes valuable. I'm Mercedes Shaffer, a commercial real estate broker and business broker, working with investors nationwide on commercial real estate deals and business acquisitions. And I'm the agent who will tell you what most other agents won't. And even though only of the real estate is being offered for sale, we're gonna do a deeper dive and analyze both the real estate and the business, because cap rates and lease terms alone do not tell the full story. My goal is to help you understand exactly what you're buying on the front end so you can avoid costly mistakes and make better, more informed investment decisions. Now, Chick-fil-A is one of the most coveted tenants in all of net lease real estate. So when a new one hits the market, especially in California, people pay attention. But just because it says Chick-fil-A on the sign doesn't mean every deal is a good deal. So today we're gonna look at this one carefully. We'll dig into the brand, the lease, the location, the numbers, and at the end, I'll tell you exactly what kind of investor this makes sense for and where I see risks. So let's dive in. All right, let's start with the basics. What we are actually looking at here. The property is a brand new 4,200 square foot freestanding Chick-fil-A in El Monte, California, built in 2024, specifically for Chick-fil-A. So this isn't a conversion or a retrofit. This building was designed from the ground up for this tenant with a drive-through, 35 parking spaces, and 193 feet of frontage on Santa Anita Avenue. The asking price is $9,950,000. That gives us a cap rate of 4.27% and a net operating income of approximately $425,000 per year. Now here's the thing, a 4.27% cap rate is on the low end, and I want to spend a moment on what that signals. In the triple net investment world, cap rate is essentially the market's way of pricing risk. The lower the cap rate, the more investors are willing to pay because they feel the risk is lower. And for Chick-fil-A, that's exactly what the conversation is here. This brand commands some of the lowest cap rates in all of quick service real estate, typically ranging between 3.5% and 4.5% nationally. So 4.27% for a brand new California location is actually right in the middle of that range, maybe even slightly favorable for this market. The lease is a 15-year absolute triple net, meaning the tenant, Chick-fil-A Inc., is responsible for taxes, insurance, and maintenance. As the landlord, your job is essentially to cash the check. The lease commenced on January 29th, 2024, so you have approximately 14 years of primary term remaining, plus 4 5-year renewal options. That's potentially 34 years of future income. And the rent increases are 10% every 5 years, which provides built-in inflation hedge over time. One more thing worth noting here, and this is important. This is a fee simple deal. That means you own both the land and the building. That's meaningful for 2 reasons. You can depreciate the building for tax purposes, and you have full ownership of the underlying real estate, which has long-term appreciation potential. Some Chick-fil-A deals are structured as ground leases, where the tenant owns the building and you only own the dirt. This is not just a ground lease, you own everything, and that's a better position to be in. Before we dive deeper into the numbers, I want to take a step back because I think it's important to understand why we're even talking about this type of investment in the first place. Robert Kiyosaki, the author of Rich Dad, Poor Dad, has a concept that I think about often. He talks about the difference between assets and liabilities. An asset puts money in your pocket, a liability takes money out. And most of us spend our lives buying liabilities, thinking they're assets, while the truly wealthy quietly accumulate assets that generate income whether they show up to work or not. Real estate, and specifically net lease real estate, is one of the clearest expressions of that principle. You purchase an income-producing property, and from that point forward, a portion of your capital is working for you, not you working for it. Here's the thing, there's always risk when investing in real estate, even absolute triple net deals. But the bigger risk isn't investing in the wrong deal. The bigger risk is not investing at all. Every year you wait is another year your money is not working for you. Inflation is quietly eroding the purchasing power of whatever you have sitting in savings. The cost of quality real estate, particularly in markets like Southern California, generally moves in one direction over time. And I'm not here to tell you that every deal is a good deal, because it's not. That's exactly why I do these deep dives, so you can invest wisely, not just invest. But the principle of putting your capital into an income-producing, hard asset backed by one of the strongest brands in American retail, that's a strategy worth understanding. Let me give you my overall read of the deal structure, because structure matters as much as the headline numbers. What we have here is an absolute triple net lease, which is the gold standard for passive real estate investing. Absolute triple net means the tenant, Chick-Fil-A Inc., handles everything: taxes, insurance, maintenance, roof, structure. As a landlord, you have essentially zero management responsibilities. That's not marketing language. That's literally what absolute triple net means. It's the cleanest lease structure you can find in commercial real estate. With 14 years of primary term remaining, this is a long duration asset. That's meaningful. A short-term lease, say 5 years remaining, creates re-tenanting risk. What happens if the tenant doesn't renew? Can you find someone to replace a Chick-fil-A? Probably not at the same rent or the same cap rate. But with 14 years left, plus 4 additional 5-year options, that risk is essentially off the table for a very long time. You have visibility into your income stream well into 2030 and potentially beyond. The 10% rent bumps every 5 years are another structural strength. In an environment where inflation has been persistent, having rent that grows even modestly is far better than a flat lease. Some older triple net leases are completely flat for the full primary term, with increases only in the option periods. That's not the case here. You're getting growth in the primary term, which protects your purchasing power. And as I mentioned, this is a fee simple asset, so you own both the land and the building. Chick-fil-A does offer ground lease structures in some markets where they retain ownership of the building, but I'll take fee simple every time, as you capture the full asset value and benefit from depreciation. Now, from a California tax standpoint, there's no favorable income tax treatment here. California taxes rental income at the state level, so you don't get the kind of tax arbitrage you might see in Texas or Florida triple net deals. That's a real consideration, and part of why California Chick-fil-A properties often trade at lower cap rates. The tax efficiency isn't the same, so some investors choose to allocate capital elsewhere. But for a California-based investor who wants to stay local, or for a 1031 exchange buyer with California-sourced proceeds, this can still make a lot of sense. And if you're actively evaluating deals like this, or you're in the middle of a 1031 exchange and need help identifying and analyzing the right investment property, my contact information is in the description below. I work with a select group of clients who are serious about executing. And if that's you, I'm happy to represent you and guide you through the process so you can make a clear, well-informed decision. Now, let's take a look at the brand. This is one of my favorite parts of the analysis because most brokers skip right over it, and it's one of the most important things to understand. Let me give you some context. Not all fast food brands are created equal from an investment standpoint. Think about the chicken wars of the past decade and where the winners and the losers ended up. On one side, you have Chick-fil-A, consistently at or near top of customer satisfaction surveys, lines wrapping around the building, drive-thrus that somehow move faster than anyone else's. On the other side, you have legacy brands that are struggling. KFC, for example, has been closing stores in recent years. Same with Pizza Hut, which saw U.S. same-store sales drop 3% in 2024 and another 5% in early 2025. That contrast matters enormously when you're evaluating a 15-year lease commitment. Chick-fil-A in 2024 generated $22.7 billion in system-wide U.S. sales. That's up from $21.6 billion in 2023 and $18.8 billion the year before that. For reference, they did $12.2 billion in 2019. This brand has essentially doubled in revenue in 5 years. The median annual volume for a freestanding Chick-fil-A drive-thru location in 2024 was 9.2 million. To put that in perspective, McDonald's, largest fast food chain in the world, has a median AUV roughly half that. Chick-fil-A runs fewer locations and does more volume per unit than almost anyone in the industry. That is a remarkable business model. Now, I want to be balanced here because growth did slow in 2024. Sales grew 5.4%, which sounds fine, but it was the first time growth came in under 10% since 2017. Consumer pullback, high menu prices, and increasing competition in the chicken segment from brands like Dave's Hot Chicken, Wingstop, and Raising Cane's all contributed. So the brand is not immune to macro headwinds. But here's the thing. At 9.2 million in median UAUV, this is still one of the highest performing concepts in the entire QSR space. One more thing worth mentioning, Chick-fil-A has maintained a franchisee turnover rate of less than 5% per year, which is extraordinarily low, and they only accept about 0.4% of applicants who want to be operators. And what that tells you is that the people running these restaurants are highly vetted, highly motivated, and have significant skin in the game. That's a meaningful risk mitigation that most investors don't think about. Looking ahead, Chick-fil-A is now expanding internationally into the UK, Canada, and Singapore. They have a $1 billion plan to grow in Europe and Asia. This is not a brand that's running out of runway. If anything, this is one of the few QSR brands I'd feel comfortable tying a 15-year investment to. Let's talk about who is actually signing the lease, because that matters as much as the brand name above the door. This lease is guaranteed by Chick-fil-A Inc., the parent company, headquartered in Atlanta, Georgia. That means this is a corporate guarantee, not a local franchisee, not a regional operator. The corporate entity itself is on the hook for every dollar of rent for the full 15-year primary term. Now, Chick-fil-A is a private family-owned company, so they don't publish credit ratings the way a publicly traded company would, but their financial position is not a mystery. In 2024, they generated over $9 billion in corporate revenue, up from $7.9 billion in 2023. Net earnings were over $1 billion. This is a company with no public debt, deeply conservative financial management, and a track record that speaks for itself. There has not been a single permanent closure of a freestanding Chick-fil-A location in the company's history. That is a very significant positive when you're evaluating the durability of the tenant. From a tenant strength standpoint, this is as good as it gets in the QSR net lease world. If I were ranking tenants by the level of sleep I'd get as a landlord, Chick-fil-A would be at or very near the top of that list. The corporate guarantee is real, the financials are strong, the brand performance supports the rent. Let's zoom out and look at the big picture, because location, even for a triple net deal, matters. El Monte, California has a population of approximately 106,000 residents and is situated in the San Gabriel Valley, about 12 miles east of downtown Los Angeles, at the confluence of the I-10 and the I-605 freeways. This is a densely populated urban adjacent market with a population density well above the national average. Now, the median household income is approximately $68,000, which is below the California state median. About 14% of households fall below the poverty line. Overall, This is a more workforce-oriented, value-conscious community, which has important implications for this investment. It tends to support strong demand for convenient, affordable dining, particularly brands that perform well on price, speed, and consistency. And that actually aligns well with Chick-fil-A's value proposition. They deliver consistent quality at a price point that works across a broad income range, and their speed and reliability make them especially appealing to commuter and family-driven demand. And within a 5-mile radius, there's approximately $5.6 billion in total consumer spending, which is a meaningful level of economic activity for a market of this size. One thing I do want to point out, though, is that the city's population has declined slightly over the past several years, down roughly 8% from 2019 to 2024. It's not a crisis, but it is a headwind worth understanding. El Monte is not a growing market in the way that Phoenix or Dallas are growth markets. This is a stable, established suburban city within the Los Angeles metro. And the investment thesis here isn't population growth. It's density, traffic, and the location quality of this specific site. Now let's zoom in and look at this specific site. The property sits at 3340 Santa Anita Avenue, which is a high visibility corridor with direct access to the I-10 freeway. There are approximately 300 vehicles per day across the I-10 and Santa Anita Avenue combined. This is a significant traffic count, and it matters because drive-through restaurants live and die on visibility and ease of access. You want to be where people already are, and this location checks that box. The site is at a signalized intersection, has a pylon sign and monument signage, and has I-10 freeway visibility. For a drive-through concept, all of those things translate directly into sales because they drive impulse visits. Someone driving home from work sees the sign, remembers they're hungry, and makes a turn. That's the model, and this site supports it well. Now let's look at the surrounding tenants, because what's around a location tells you a lot about the quality of the trade area. Within walking distance, you have Starbucks, Jersey Mike's, Wingstop, Jack in the Box, Little Caesars, Ross Dress for Less, Petco, Five Below, and Chase Bank. You've also got multiple hotels nearby, a Hilton, a Sheraton, a Courtyard, which add a consistent daytime and transient customer base. Here's what I take from that list. This is a destination retail corridor. When you see Chase Bank, Ross, and Petco anchoring a trade area, that tells you the real estate has been vetted by national retailers with significant site selection resources. They don't go where the trade areas doesn't work. Let's talk about the physical asset, because when you're buying a single tenant triple net property, you're buying a very specialized building. This building was constructed in 2024, purpose-built for Chick-Fil-A. It's 4,200 square feet, which is a fairly standard footprint for a modern Chick-fil-A freestanding unit on 1.89 acres of land. It includes a drive-through, which is essential, and 35 surface parking spaces. The building is brand new, so there are no deferred maintenance issues, no aging HVAC systems, no roof concerns in the near term. You're buying new construction. Now here's something most investors overlook, and it's actually one of the more important things to understand about Chick-fil-A specifically. Each franchisee operating Chick-fil-A is on a periodic remodel schedule required by the franchisor. Chick-fil-A has a tiered approach, ranging from a light refresh with updated signage and minor modifications, all the way up to a significant remodel. Because this building opened in 2024, a full remodel is not on the horizon for many years. And that's a meaningful advantage, because remodel obligations can be financially stressful for operators. And in some cases, if a franchisee can't absorb the capital expenditures, it can create risk around lease continuity. That risk doesn't apply here in any meaningful way for the foreseeable future. As a landlord in an absolute triple net structure, the tenant is responsible for maintaining the building. But I still care about the building quality, because if the store ever closed, which at the moment with a Chick-fil-A, the probability is historically very low that this would happen, I'd need to assess how retenable this space is. And the good news is that a 4,200 square foot drive-through building in a high traffic California corridor is actually quite re-tenantable. Other QSR brands, coffee concepts, or even fast casual operators could easily step in. The freeway visibility and the drive-through infrastructure have broad demand. You're not stuck with a White Castle conversion in rural Iowa. This is Los Angeles adjacent real estate. Now let's talk about the rent to sales ratio. This is a section that most people skip, and it's one of the most important analytical tools I use. Because here's the thing, the lease is only as good as the business behind it. Let me explain what I'm looking for. The rent to sales ratio, sometimes referred in the context of EBITDA, tells you where the underlying business can sustainably support the rent it's paying. In the restaurant world, a healthy rent to sales ratio is generally between 6 and 10%. Closer to 6% means the business is running comfortably. At 10%, you're approaching the upper boundary of what most operators can sustain. Above 10%, and you start to have a real problem. So let's work through this. The rent on this property is approximately $425,000 per year. Now, the median annual sales volume for a freestanding Chick-Fil-A in 2024 was $9.2 million. If we assume this location, brand new, freeway visible in a dense Los Angeles suburb, performs at or near median, we're looking at an annual sales somewhere in the 8 to 10 million range. Let's be conservative and use 8 million. $425,000 in rent divided by 8 million sales gives you a rent to sales ratio of approximately 5.3%. That is well within healthy range. Even if this location underperforms, say only does 6 million, you're still at roughly 7%, still within the acceptable band. This business has to significantly underperform the brand median before the rent becomes a burden. Now, Chick-fil-A's EBITDA margins at the unit level are among the strongest in fast food, largely due to their high throughput, simple menu, and operational efficiency. Operators are running lean, highly trained teams, and the economics at the unit level are generally very healthy. So this location is not only positioned to comfortably absorb rent today, but also to support future rent increases as those step-ups occur over time. Now let's talk about what this deal actually looks like from a number standpoint, because I want to ground this in reality. You're purchasing this at just under $10 million. Day one, you're collecting approximately $425,000 in annual income, or about $35,000 per month. If you're financing at current rates, which most buyers will, and coming in with around 40% down, which is typically where lenders cap leverage on an asset like this, you're looking at a loan of just under $6 million. At an interest rate of about 5.85% amortized over 25 years, your annual debt service is going to be roughly $450,000. So in year one, you're actually looking at slightly negative cash flow of about $20,000 to $25,000. That's important to understand up front. This is not a high yield day one cash flow play. And any opportunity that's a 4.2% cap rate with 40% down is going to be slightly cash flow negative initially. For some investors, that's part of the strategy. They value leverage and appreciation over cash flow in order to position themselves for greater long-term gains. So this is where it gets really interesting. What you're actually buying is something different. You're buying a 14-year corporate income stream with built-in rent increases every 5 years. When that first 10% bump hits, your rent goes from roughly $424,000 to approximately $467,000, and your loan balance has been getting paid down the entire time. The combination of increasing income and decreasing debt is what makes this strategy powerful, not in year one, but in year 5, 10, and 15. Now, if you're coming into this via a 1031 exchange, perhaps you've sold a multifamily property, you've built up significant equity, and you're applying a much larger down payment, the math looks quite different. A larger down payment means less debt, which means more cash flow, and a cleaner, simpler income stream. For someone coming out of the complexity of managing apartments, this can feel like a breath of fresh air. You're exchanging operational stress for simplicity, and that trade-off has real value that doesn't always show up in a spreadsheet. All right, now for the $1 million question, or in this case, the $10 million question. Is this a good deal? The answer is, it depends on the buyer and their goals. And here's how I'd frame it. If you're a first-time triple net investor or someone coming out of a 1031 exchange with significant equity who values certainty above all else, who wants to sleep at night knowing that one of the strongest brands in American food service is legally obligated to pay your rent for the next 14 years with rent increases built in and absolutely zero landlord responsibilities, then this deal makes a lot of sense for you. You're paying a premium for that certainty. A 4.27 cap rate is not cheap, but you are getting the gold standard of net lease tenants in a well-located California asset. If you're a yield-driven investor, someone who needs 6 or 7% cash-on-cash return from day one, and you're financing a significant portion, this is not the deal for you. The early year negative cash flow simply doesn't support that goal. You'd be better served looking at secondary market assets with higher cap rates. Though I'd encourage you to research carefully what you're trading off in brand quality and tenant strength when you pursue that yield. So here's my honest assessment. This is a high quality asset at a high quality price. The brand is exceptional, the lease structure is as good as it gets. The building is brand new, the location is solid, with strong traffic and good surrounding tenants. The risks are real but manageable. El Monte's flat to declining population, California's tax environment, and the premium price point all deserve consideration. But if your goal is long-term wealth building, passive income, and the simplicity of owning a hard asset backed by a corporate guarantee from one of the most operationally excellent companies in American retail, this is a serious contender. What do you think? Does a 4.27 cap rate make sense given the brand and the California location? I'd love to hear how you're thinking about it. Drop your thoughts in the comments. Tell me what you look for when you evaluate a brand like Chick-Fil-A and whether you think the premium is worth it in today's rate environment. Now that we've covered the core strengths and the risks of this opportunity, the real question is, what's the right investment strategy for you? Because every investment carries risk, including triple net real estate. And what we covered today is a high-level overview. When I'm working with a client, we go much deeper because there's no such thing as a risk-free deal. The difference is how you evaluate that risk and whether the asset actually aligns with your short and long-term objectives. When it does, this can become a very powerful vehicle for building wealth through passive income, leverage, and long-term appreciation. But when it doesn't, that's where investors can run into problems that are very difficult and very expensive to unwind. And that's really the key, understanding what you're truly acquiring. Not just the lease, but the strength of the tenant, the durability of the brand, the unit economics, and how this asset is positioned to perform over time. Because this is not something you want to get wrong. My goal is to make sure you fully understand what you're buying on the front end so you avoid costly mistakes entirely. And if you want to see more breakdowns like this and stay informed on the types of deals and opportunities that are actually out there, make sure you subscribe so you don't miss the next one, because these opportunities change quickly and understanding how do you evaluate them is what puts you in a position to act when the right deal comes along. And if you want more breakdowns like this and a clear view into the types of deals and opportunities that are actually hitting the market, and if you're actively looking or in the middle of a 1031 exchange and want an agent who can help you execute on an investment property, I work with a select group of clients and guide them through the entire process, from identifying the right opportunities through acquisition. With my background in both commercial real estate and business brokerage, you're not just looking at the lease, you're understanding the full investment. And if you're busy, I handle all the heavy lifting and bring you the bottom line so you can stay focused on what you do best. If that sounds like what you're looking for, you can reach out to me directly using the contact information in the description below, and we can talk through your situation and what actually makes sense for you. And the last thing I'll mention, if you're an owner thinking about selling and want your property positioned to a highly targeted pool of real estate investors, I work with a strong network of active buyers, and every property I represent is featured here on the Commercial Real Estate Deal Room, where it's presented in a clear, accurate way so it reaches the right buyer for that specific opportunity. Thanks for watching. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room. I'll see you in the next deal.